Hi guys, today's video is about accrual accounting and the recognition of revenue and expenses. So the objectives today are to understand the impact of accrual accounting on revenue recognition and to understand the impact of accrual accounting on expense recognition. So the background today, so what is accrual accounting? Accrual accounting is an accounting system that recognizes events and accounting transactions that are essential to the portrayal of financial position and performance. So what it basically means is we're recording the substance of the transaction and its corresponding impact on assets, liabilities, and shareholders' equity. So in order to do that, we record revenue and expenses when we judge it necessary in order to portray fairly the economic inflow and outflow into the organization. And that pretty much means that we record transactions or recognize revenue and expenses as they occur if we find it necessary in order to portray our financial position and performance fairly, so that we're not manipulating the numbers and they portray what we have and what we are owed. So in contrast to cash accounting, it's fairly arbitrary, and that records transactions at the time when cash changes hands, so there's no judgment or anything. So it's pretty much it's pretty much cash flow or cash accounting versus economic flow, which is accrual accounting. So there's an issue if we use accrual accounting because recognition always depends on good judgment, because we judge when it is necessary. So as a result, there are three scenarios. So there's a recognition of revenue or expenses at the same time as the cash flow. There's recognition of revenue and expense before the cash flow, and then there's also recognition of revenue and expense after the cash flow. So we look at each separate scenario. So we start off with number one. So when we recognize revenue, say revenue, at the same time, so revenue recognition. So the example today I've given is, so SCT Ltd sold 2 balls for $20. It cost them $10 to buy from suppliers, and the customer paid in cash. So in order to record this, we record cash of $20. Then we record our sales revenue, $20. You see these are at the same time. Then we record our COGS, which is $10. And then we lastly record our decrease in inventory of $10 as well. So if we see here, the cash and the sales revenue were recorded at the same time. And then similarly with expense recognition, say SC Ltd paid $100 for their cleaners. So we have a cleaners expense of $100, and then we also have a credit cash $100 that we're paying out. So if you see here, our expense and cash are recorded at the same time. So what happens when we recognize revenue or expense before the actual cash flow has taken place? So if we draw a timeline, we recognize revenue now, and then we just have after we receive the cash, before we've received the actual cash. So I need to make sure that you all remember this. The revenue is recognized when it is earned and not when it's paid, and expenses are recognized when they are incurred and also not when they're paid. So if we go to revenue recognition, or the economic inflow, that is recorded first. If we look at our example, so SC Ltd, it sold 2 balls for $20. It cost them $10 from their suppliers, and customer paid with credit. So what do we do here? So firstly, we have our debit. We have debit accounts receivable, so we are owed $20, and then we also credit sales revenue. So we're recognizing the sales revenue first, and we recognize that they owe us, but the cash has not been paid, and it's paid later on. So then afterwards, we also do need to recognize the expense, which is the COGS, so $10. And then we also need to recognize the reduction in inventory of $10. So what happens when the cash is finally paid, or when the cash flow actually happens? Then that's when we reduce our accounts receivable by $20, and we increase our cash by $20. As you see here, there's no impact on revenue. Revenue is already recorded when we have earned the economic inflow, and then cash is recorded afterwards. Okay, so then when we go to expenses, so when expense recognition occurs or the economic outflow occurs, the example I've given today for when the economic outflow occurs before the cash outflow, given so SC Ltd received an invoice on the 20th of June for fixture maintenance for the previous month, and that's $100 to be paid by September, which is in the next accounting period. So of course we do need to debit our expense, so we do recognize our expense, $100, and that is maintenance. Expense of $100, and then we also need to recognize our obligation of $100 that we need to pay. So then what happens when the cash is finally paid, or when the cash outflow occurs? There's no impact on expense. We just need to debit accounts payable of $100, and we just credit cash that we paid out of $100. So as you see here, the cash has been paid out after the expense recognition, and therefore the economic outflow was recognized before the cash outflow. So if we look here, so the economic inflow for revenue is its value gained but not yet physically realized until cash is actually paid to us. And then the economic outflow from expenses is value that is lost but not yet physically realized until the cash is paid out to someone else. So if we go to the third scenario, so recognition of revenue or expense after the cash inflow or outflow. So if we draw our little timeline, so cash is received first, but we don't recognize revenue or expense until afterwards. And that's because revenue has not been earned yet, or the expense has not been incurred yet. So if we go here, so for revenues, so physical recognition occurs first, so the cash inflow comes in first. The example I've given today is SC Ltd receives $500 in advance for a one-day coaching clinic and coaching class, and that begins next year. So we debit cash of $500, and we have a new account called unearned revenue, and that is a liability account, and it shows it's an obligation to provide those services in the future. So we do owe that to them, and we have not recognized that revenue yet, and that's why it's unearned. So what happens when we actually do recognize our revenue, or when the economic inflow actually does occur? So it will occur once the coaching clinic has ended or been provided, and then therefore the revenue has been earned by our coaching staff. So then we go to our debit. So we debit unearned revenue, $500. So we just close off that account, and then afterwards we credit our service revenue or coaching revenue of $500 after we've actually earned that money. And then lastly, we go to our expenses. So we have a physical recognition of cash outflow first. So SC Ltd pays $5,000 to insure their facilities on the 1st of June 2012. So we have this new account called prepaid insurance. It's kind of like a deposit. Well, not like a deposit. They paid $5,000 for services in order to insure them. And then we credit our cash account. So cash has already been paid out. And so that prepaid insurance is an asset. It entitles us to a service or compensation throughout the insurance coverage. So benefits are consumed with time, and then accordingly, as a result of the matching principle, the expenses will be consumed as the time elapses or as the benefits are consumed. So what happens when the expense recognition occurs, or the economic outflow occurs? So say on the 1st of June 2013, a whole year after the insurance is paid and therefore expired, we credit the prepaid insurance of $5,000. Oh, sorry, that should be $5,000. And then we debit insurance expense of $5,000. Now normally this like prepaid insurance, it will age over time, so you can do this monthly. So all you need to do is divide the $5,000 by 12. Okay. Divided by 12, and that would give you $416.67. So we can put this every single month. So for example, on the 1st of July 2012, we'd have a debit, credit. We'd credit prepaid insurance. So 1/12 has been consumed over that 1 month. So $416.67. And then we credit insurance expense. Similarly of that much. And that will occur 12 times until this is this $5,000 balance on the balance sheet will be diminished to 0. So that's it for today, guys. I hope you learned something. Thank you.
Cut study time with concise video summaries by top students. Visit spoonfeedme.com to view more free videos in this course and hundreds of others.